Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And what is velocity banking? It is a debt payoff strategy. Debt payoff strategy. And you could see from my YouTube feed that a lot of people are struggling with debt. And so, because so many people struggle with debt, a lot of people don't think it's possible to get out of it, right? And so that's why I know when I teach velocity banking, I don't think anybody actually, like, believes me when I say I did it, you know what I mean? Like, "Okay." Like, I paid off my mortgage in 2 years and 9 months, like, and you might be like, "What? What did you say?" "Yeah, I did." In fact, if you take a look here, let me show you my mortgage statement. If you're new to this channel, I paid it off in 2 years and 9 months, and, just a chance for me to brag, No, every time I make a new video, it just kinda lifts up my ego, and I'm like, "Yep, that's me," and then play the cue music, you know what I'm talking about? Actually, let me go ahead and find that, give me one moment. Okay, I found it, so let's go ahead and play it.
Yep, that's me. You're probably wondering how I ended up in this situation.
Yeah. What movie is that from? I feel like it's been in a lot of movies, but then every time I do a Google search, it's like I can't find the movie. But yep, that's me. I paid off my mortgage in 2 years and 9 months, and you're probably wondering how I did it. Well, I'll tell you how I did it, which is I threw all my money into debt. That's how I did it. Okay. All right. So let's get started. How do you do velocity banking? First step is a budget. So kind of do it right here, budget. And the whole point of the budget is to list your income, list your expenses, and then see what's left over in your savings. And then you have to do an expense breakdown because this is a debt payoff strategy, right? So you list every single debt that you have, every single one. And then at the very end, you have your food, gas, insurance, right? $2,200. And we're always going to pay this. We assume we're not trying to necessarily cut costs. We're trying to stop paying the debt, all right, or pay off our debt quickly so that basically the bank isn't making bank off of us. Yeah, I see. I'm a comedian. Actually, I'm not. But all right, so let's go ahead and get started with the velocity banking side. So the cool thing about velocity banking, when we demonstrate it, is we say, "Hey, same income, same expenses." Okay. Oh, where'd I go? But this is why people feel so uncomfortable with this. You don't save money. I know, right? You don't save money. Let me dramatically zoom in. You don't save the money, okay? 80 so if you ask the average American, like, hey, which do you think would be better? Saving $82 a month or saving zero? They would prefer to $82 because I don't know if you ever, like, felt this social conditioning, but people feel really, really weird when they don't have any savings at all, even though they got a lot of debt, right? And so if I show people my checking account, right? My checking account, it's pretty much always at a 0, right? Always at a 0, and I know you're probably staring at this, but it's pretty much always at a 0, right? And so, most people can't handle that because when you see your checking or savings account and there's a big fat 0, you're like, "I something's wrong," right? Something's wrong, but actually it's actually well, I can't give you financial advice, but it may feel so wrong, but it might actually be right. See that I think that was a song a long time ago. Alright, so $0, okay? And so what I'm gonna do is we're gonna dump all of our money into debt and increase this thing called cash flow, even though we don't save money. See, velocity banking at its core is not saving money rebranded 2.0, right? Not rebranded 2.0, not saving money. But take a look at this, okay? Now, let's assume we had maybe something called a line of credit. So at $100,000 limit, so what's a line of credit? Kind of like a credit card. Well, technically, a credit card is a line of credit. All it is a financial tool where you could borrow money, pay it back, and use it over and over again. So I'm going to show you my home equity line of credit, right? So this one right here, home equity line of credit. So what does that mean? Okay. I could literally go into the bank's website, click a button, and then they'll dump up to $280,000 into my checking account and then charge me a 7.5% interest rate. Okay. And a lot of people think I'm lying. They tell me, when I tell them like I know what I'm doing, right? It's like you don't know what you're doing. Like you don't know anything about credit, and I don't know. Maybe I don't know what I'm talking about, but at least I have $594,000 in lines of credit. 594,000. Okay, and here's the secret to getting all the credit, all of it. Banks don't lend money to people who need it. And the reason why so many people struggle with dealing with banks is because they only try to get the money when they need it. And don't do that. I'm going to tell you, if you do that, you're going to struggle. Banks don't lend money to people who need it. That's the secret. And once you understand that secret, you will probably know. I'm not saying for sure 100%, but you will probably know how to get the credit. And that's how I have over $594,000 in lines of credit. It's simple, right? It's simple. What am I doing here? All right, let me go ahead and all right. So here's what we're gonna do. Okay, we're going to make our line of credit as a main operating account. So what does that mean? I'm gonna move some debt, right? I'm gonna move some debt, and actually, let's make this easy. Let's make this 120,000. Okay, I'm gonna move some debt into the line of credit, and then we're going to increase our cash flow greatly. So what is this? This is a $27,000 credit card, 30, 50, and let me go ahead and sum this up. It's $107,000. So let's move $107,000 from the credit cards into the line of credit. And what happens here? Zero, zero, zero. Oh my goodness. Did you see that? Do you see why we don't save money? Because we can only go from 82 to $3,528.87 in cash flow. Let me dramatically zoom up. And by the way, if you show your friends this, do you think like they'll actually like process it? Because it's like, how do we go from here to here? Like, how literally did we go from here to here? Same income, same expenses, although we shuffled some of the expenses around. But look at this, $82 literally turned to $3,528 of cash flow. And here's the other thing too. Banks don't lend to poor people. I know you see this and it's like, that's a pretty good income. Banks don't like poor people. Banks don't lend money to people who need it. So if you ever ask me, and I used to receive these comments until I started explaining to people how banks work, that they don't lend money to people who need it. Well, can you do it with the low income? Banks avoid low income people, right? I'm just being real with you here. A lot of people don't like hearing that. And the reason why a lot of people don't like hearing that is because they've been socially conditioned by media. Like, you ever watch a bank commercial and they were always telling you the exact opposite what they would do? Because, like, hey, they'll say stuff like, hey, we're going to be here when you need us, which is not true because they only lend money to people who need it. They only lend money to people who need it. And I actually, let me just do a quick Google search right here. Banks avoid poor people. And I think there was an article on the New Yorker. Right. Oh, look at this. 2010. The bank's computer still says no to poor people. No to poor people. Right. So banks don't lend money to people who need it, folks. I know. So, and here's the other thing too. If you just the fact that you have a mortgage, did you know in this country, 90% of people in this country can't qualify for a mortgage? I know, crazy, right? So, just the fact that we have a mortgage makes us like 90% of people can't even do it with this budget and scenario. All right, so let's go ahead and get started and do the final step, which is you put your entire paycheck, $8,200, into the line of credit. So what does that do? It satisfies the minimum monthly payment, and then you take your expenses out. And also, it minimizes the interest because the interest is based on the average daily balance. And then after every single month, the balance of the debt will go down by $3,528.87, right? So I'm going to do this, and then I'm going to do this. And basically, to get the next month's balance based on the previous month's balance, interest, and then you subtract your cash flow. So what is our cash flow? Which is 3528.87. And then after every single month with the line of credit at 8%, in order to calculate, it's based on the average daily balance. Average daily balance. So what we do is get the average of these two numbers here as a way to get the average, multiply it by the interest rate, 0.08, and then you divide by 12, right? It's not 8% monthly, it's 8% annually, which is why you divide by 12. All right. So now let's go ahead and copy and paste this schniz, Wiener Schnitzel. Actually, it's been a long time since I have Wiener Schnitzel, probably more than 10 years. All right. And then 34 months, it is completely paid off. 34 months, right? And so let's go ahead and do this right here. And so it's 34 months. And then this is how much was that? That was 107K. So less than 3 years. And again, it's not 3 years when we had plenty of money available. It's 3 years when we literally had $82.02 left over. $82, or not 2 cents, 20 cents. Do you think most people believe me when I tell them I paid off my mortgage in 2 years and 9 months? Nope. And then once I show them this, their brain short circuits. It's true. Like, why do you think with the people that I know, nobody really does these spreadsheets except for me? Because this is kind of like financial evangelism. And I feel like, hey, if at least one person is going to learn it, might as well, right? It's worth it. In fact, I had someone tell me today that this person paid off a car in 7 months with Velocity Banking. 7 months. And I was so proud. I was so proud. Okay. Tears in my eyes. Tears in my eyes. All right. So let's go ahead and do this. Well, actually, I didn't have tears in my eyes, but I had the emoji tears. But let's go ahead and figure out after paying off the credit cards, what do we do with these 4 loans, right? And if we go to the loan calculator right here, because we have this loan calculator, and what month are we at? We are at month 34. We just type in the current month and then it'll spit out the current balance, 34, 34, 34, 34. Now, I know what you're thinking. So there's a reason why this interest rate is highlighted red. It is the highest interest rate. And a lot of you are thinking, like, shouldn't I tackle this one first? Maybe it's legit. It's a legit strategy to want to attack the highest interest rate. But why not get as much cash flow as you can in the beginning? So what we do is we take these balances and get about $800 of our cash flow back rather than tackling the 30 grand and only getting $424 of a cash flow back, right? So basically, there's this formula called the cash flow index. It's just a current balance divided by the payment, right? It spits out an arbitrary number. And the lower the number, the more bang for you buck you get in terms of cash flow. So if you pay off the 30 grand, you only get $424 in cash flow. You pay off, let's say, about 20 grand, you get about $800 in cash flow. So which one gives you more bang for your buck? Let's take these, right? And then I am going to sum up this. So 19 grand is these 2 loans. And then let's move them into the line of credit. All right. So I'm going to do this. And then this is going to be plus 19555.83. And then these 2 loans get paid off 0, 0. And then 4 grand. 4 grand is the cash flow. So let's go ahead and copy and paste a new cash flow, which is 4310.93. And whoopsie, what did I do here? Let's go ahead and copy and paste this correctly, right? Yeah, that's what we need to do. Okay, so now in how many months? 1, 2, 3, 4, 5. In 5 months, we paid off 2 cars completely. 5 months. Amazing. All right. So this was at 39 months. 39 months. All right. Okay. So 39 months. And then that's going to be 107 plus 21 plus 22. That's 150K. 150K. And then now let's tackle the student loan at 39 months and see what's up with the student loan. So 39. We have 29 grand in the student loan. Let's go ahead and move it into the line of credit. Now I'm going to give you a warning that this may not be the most financially optimal decision because, okay, especially with the lower interest rate loans, if this number is too high and this number is hugely different from the line of credit, we'll end up paying up more interest than we have to. But this is only really a big thing we have to worry about when it comes to a 30-year mortgage, which I'll briefly explain. But for now, let's just move this loan into the line of credit. Okay, so let's go ahead and do that. And then this is going to be plus 29116. And then how much cash flow do we get? It's an extra $424. Okay, and then 4 grand of cash flow. Okay. So this is going to be 4735.19. All right. And then now 45 months, it is paid off. So not bad, 1, 2, 3, 4, 5, 6 months to pay off the student loan about. And this is going to be 45 months. So let's go ahead and write this down. 45 months, and then it's going to be 190K. And let's go ahead and now go to the loan calculator at 45 months and see the current balance. All right, so the current balance is 275,000. Now, some people on the internets are saying you must always move this loan into a line of credit. And that's actually not true. Because think about this. If you move this 3% loan into, let's say, an 8 or 10% line of credit, and you're only getting, if you pay 275,000 to get this $1,200 of itty bitty cash flow, that's a no bueno. Okay, that's a no bueno. What happens is that a lot of times, people kind of make decisions they may regret. Because I remember a comment on the YouTube video on this YouTube channel where people said, "I regret moving my 2 point something percent mortgage into a 9% line of credit or something like that," because you end up paying way more interest. Okay, and we don't want to do that. We don't want to end up paying way more interest. So this is what we're going to do. Okay, we're going to talk about the two methods of paying on debt. So the first one is what we call the chunking method, right? So the chunking method is basically you just move a piece of the loan into the line of credit. Okay. Now, let me go ahead and just write the financials here. So 8,200 is our income. So 8,200. And then our expenses, what's our expenses? Is everything except for the loan we're trying to pay off. So 2,200, 2,200. And then we'll do a $9,000 chunk amount. And then what's the original balance of the loan, which is going to be 300,000. And then what's the current balance? It's 275,512.41. So 275,512.41. And then what is the payment amount? It is 1,264.81. 1,264.81. And then you see right here, it gets paid off in 4.1 years and 18.5 grand of interest. Now, let's move the whole thing into a line of credit. Okay, so let's see what this is. Sometimes you might see on the internet. Ooh, 55 grand. That's a no bueno. Okay, and here's a crazy thing, right? If I pay 9 grand and I do a 30%, using a 30% credit card, take a look at this. I only pay 23 grand. But even if I move the whole, let's see, hold on, I screwed up. Let me do a redo. Okay, so even if I move this whole thing, okay, into the line of credit, the 30% credit card with small chunks will actually beat the 8% moving the whole loan into the line of credit. You don't want to move the whole loan into a line of credit. Like, why would you pay 55 grand when you can just simply do it and pay 18 grand and pay it off quicker? Right. And if you don't know where I got this is from Renatus, right? Renatus is where I originally learned this velocity banking, blah, 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 blah. And I also am an independent contracted marketer for them. So I want to sell people who want to learn. Right. And so if you're interested in learning and possibly joining a cult, click the Google form link below. Other than that, let's go ahead and type the 4.1 years. And then I'm going to do this right here. So 445 divided by 12.4.1, 7.85 years. And then this is going to be 490K. And again, have you ever watched like those velocity banking channels where it's like be mortgage free to 7 to 10 years? Like we actually did it in 4.1. Almost as good as me, but not as good because I did, like I said, I did mine in 2 years and 9 months. 2 years and 9 months. right? I know. I don't even believe it when I say it. So, yeah, that's pretty much it for today. Mhm. And remember, banks don't lend money to people who need it. That's how you get the credit. And here's the ideal target client for a bank, and you might not realize this. It's someone who makes good money and is just kind of bad at managing it. Not so bad that you never pay him back, but you don't want to be so good that you pay him off too early, right? And now we are in rich people problems territory, $6,000 a month of cash flow, which will now turn into our savings because we have money. And yeah, no more debt payments. Am I right? Okay, well, that's it for today, folks. This is Korean Lanta Mentorship. So have a great day, and I'll see you all on the next video.